wouldn't it be interesting if we can apply those same principles that we were using when we were trying to help American Airlines select pilots, or we were trying to help Subway restaurants select managers and things like that? And wouldn't it be interesting if we can apply that same kind of thinking, but we do it for founders?
This is the Angel Next Door podcast, where we will talk about all things angel investing, what it is, who does it, how do we find them, what does it mean to invest in an early stage company. If you have ever wondered how you can affect the change you want to see in the world, then tune in to learn more. In this episode, I'm talking with Greg Moran, a seasoned entrepreneur turned investor who shares insights about the vibrant tech ecosystem in Denver and his investments within the future of workspace. Greg has written a fascinating new book, The Adaptive Innovator, which explores the traits of successful founders based on research he gathered. He tells us about the 4 traits we all should be looking for. Enjoy the show. Greg, welcome to the Angel Next Door podcast.
Thanks, Marcia.
I'm excited for you to tell us a little bit about things that are happening in Denver, considering the Angel Capital Association's annual summit is about to be held there in April 14th through the 17th. So excited to hear a little bit about that, but you've also written a very interesting book that comes out soon. So I want to hear a little about that too. But tell us a little bit about your background and how you got into investing and to know all the things you know.
Sure. Yeah. My serial entrepreneur is how I started. What actually started me on the road to investing, and have founded a number of companies over the years, and some of them have managed to work out pretty well, and some of them not so well. Those are the better stories, but
Always, yeah,
right. They're at least the funnier stories. But been fortunate. I built a few companies, mostly all within technology and mostly around the HR technology space. All of those companies that we had successful exits on were in the principal area of employee selection, talent selection, recruitment technology, that kind of a thing. So really developed my career there. My last company I sold, interesting, on March 1st of 2020. So if you remember what the world looked like at that point, we sold to a large private equity fund. So it was a great exit. But yeah, the timing on that could not have been any more bizarre. We had a couple hundred people in different parts of the world at that point. And we were growing well, and stuff was happening. And then not only did we sell the company, and then the world shut down a couple of days later. Funny story about that, actually. So I live in Denver, and we'll get into Denver in a minute. I live outside of Denver in Colorado, up in the mountains. But my office is actually where I'm sitting today in Dallas. So I would commute down here every week. And we closed the transaction. We finally closed the transaction with the private equity firm who acquired us. And it was we had a nice celebration for everybody in the office. And this was on, I think, February 28th of 2020. And everything was going crazy, right? And we had 150 people or something there. We ordered tons of sushi, right? So we had sushi everywhere, we had a giant commercial kitchen. So at the end of the day, we took the leftover sushi, we put it in refrigerators, and I left. And that was on February 28th, 2020. And the transaction finally closed the next day. And I went back to that, and then everything shut down. And I went back to that office for the first time in July, and the sushi was still in the refrigerators.
Oh, no.
So that was just one of those humbling experiences where there's nothing quite like 3-month-old sushi that's been lying around in an office when the world has shut down for a pandemic.
That's crazy.
Yeah, bizarre. So anyway, we had sold that company. I stayed on as the CEO for about 18 months. But over the course of that business, over the course of the businesses, I had raised about $500 million in capital, and at every stage, right, pre-seed, all the way through large sort of growth exits. And what we really wanted to do was go back to the start again, right? We were 50 plus million in ARR, 400 people at that point, and really wanted to get back to the early stage, but wanted to do it from the other side and go from the investment side. So we launched a fund called, Evergreen Mountain Equity Partners. Evergreen Mountain happens to be in my backyard in Evergreen, Colorado. And so we launched that fund really to do primarily seed and Series A investing. So post-revenue, but still really early stage stuff. It's a thesis-driven fund really around this core thesis of the future of work. So we really invest in kind of 4 primary areas within the future of work: automation of the workforce, AI in the workplace, globalization and mobilization of the workforce, and the gig and freelance economy. So those are all within technology. So that's where we invest really early stage. But we also want to do is make this fund every, I think every fund, at least I had this experience many times, right? Every fund talks about founder friendly, but we're not sort of your typical VCs, right? We didn't come out of Ivy League schools, get our MBA, go into the investment bank like that kind of traditional path. We were founders. My partner in the fund and I were founders, and we wanted to really truly give founders the resources to be able to really support them on the journey in a different way. That's why we built the fund around this concept of we want to invest in what we call find a way founders, right? Founders who have the grit, they've got the determination, they've got the resilience, but they may not have the traditional background, or they may not have the contacts and things like that, and really help boost them up. It's been an incredible ride. We continue to build that fund. We've been investing for about 2.5 years.
So how much did you raise then in total?
It's a small fund right now. It's about a $10 million fund. This is fund one, being first-time fund managers. Really, most of our LPs today are people that we know, we've worked with. We've got new LPs coming into the fund now that we're getting to know now. But it's a small fund. As these things go, you want to go out, you really want to prove out your model, you want to prove out your thesis, and it's been fantastic.
And how many companies have you invested in so far?
We've got 9 in the portfolio today. As our model on this was a little bit different in that where I think a lot of early stage funds tend to take a portfolio management approach on this. Like you end up with a fund of 50 companies and you expect a bell curve, right? And the far side of the bell curve is where all your returns are going to come from. And what we really wanted to do was index on that support of the founders and really give them an outsized advantage. And what we're seeing today is, I'd say about 60% of our fund is pretty well positioned right now, and with a few that have a pretty extraordinary opportunity here. So we've been happy with the performance so far. The model seems to be working in the way that we had expected it to.
And so you get relatively involved then in each of the companies.
We get really, yeah, for the most part. We're flexible on that, but we do typically take a board seat, mostly because we don't mandate it. But I think most of the time, the founders that we work with typically want us to take a board seat because we tend to be very value add focused, right? So we do get strategically involved with them. We've got a really strong operator partner network where we help bring in the talent that they need on a fractional basis and things like that. So we really do get involved. But again, we don't have to operate like that. It's just, it has worked. That model has worked really well for us because of the background. And quite honestly, it's because it's what we're passionate about, right? Founders are my people. It's where we love to spend our time in helping to guide and just be a part of be a strategic resource for them.
You evaluate companies when it comes to AI, because that's something that I hear from a lot of, especially like angel groups or small funds. They're like, well, everybody's talking about AI, but we really don't know how to do diligence on something like that because it changes so fast.
Yeah. Look, I think rule number one, if anybody tells you they've got a great answer to that question, they're probably full of it. It's changing incredibly quickly. And one of the fundamental challenges, I think, with any investor today, whether you're an angel investor or you're institutional investor, one of the fundamental challenges today is to try to have some idea of where you think the direction of this is going to go. And SaaS has been such a fundamental part of the investing landscape for a few decades now. So here's what I'll tell you. Here's what I'm completely convinced of. Every one of our portfolio companies has to have an AI strategy. If that AI strategy is just simply building something that sits on top of ChatGPT, that's not going to cut it. But I don't know what the right strategy is, but I want them to have one. And I'm not sure exactly where it's going to go, but neither does really anybody else. Here's the other thing I'll tell you, and that we talk to our SaaS, and just about every company in our portfolios is SaaS. It's going to have the way that we think about SaaS investing today and the way that we think about SaaS companies, it's not going to look like that over the next 3 to 5 years. And it's going to change fundamentally. It's going to be much more of an API driven. These technologies are going to be APIs into LLMs and other AI platforms where the actual like workflow, UI, things like that we think about as SaaS today, it is going to be really less important, right? And so we want our companies thinking in those terms. And when we're evaluating new opportunities, we're also thinking about it in those terms. But I have no idea what the answer is going to be, right? Because the stuff is just evolving. You look at the leaps that are occurring on a, what was it, 18 months ago, I think it was, ChatGPT didn't exist.
That's right. Yeah.
So you start to look at the pace of this, and you look at what Claude is now doing from the ability to develop software, and it's remarkable. So I guess the answer, it's not a very satisfying answer, but I think the answer is we want them thinking about it. We want them to have a point of view, but it's anybody's guess how that point of view is going to play out. But if they're thinking in terms of this is going to be iterative, or this is going to take a while, and I'm going to ride this traditional SaaS model out for as long as I can, that's a problem.
Mm-hmm. Yeah. We've been told something along the lines of you just really need to make sure they're solving a big problem. And then how does AI fit in that as a part of it? But if they aren't really solving a big problem, you can't get down to the fundamentals of an actual business that makes money, then, you could end up with issues.
Yeah. And I think that's a good perspective to have. And that's the same thing as SaaS. It more becomes the how than the why, like what, or the what is that fundamental, that core problem that you're going to go try to deal with. Maybe the how is SaaS. Maybe it's going to be APIs into AI platforms or things like that. But that becomes a how, and you're just, that kind of iteration is going to need to be there pretty quickly.
Yeah. So tell us more about the book. What caused you to write it? Tell us all about it.
Yeah, sure. So I talked about in the fund, I talked about my background coming out of like HR related, talent selection related technology. And then when we started the fund, like I said, we're extremely focused on backing founders, right? That's what we do. The product market fit, we can figure that out or help them figure that out. AI strategy, things like that, we can help them figure it out. What problem that they're solving, we can even help refine that a little bit. What we can't refine is the quality of the founders that we're investing in. We got to get that. And that's the first decision that we need to make is, do we have the right founder? Because we can pivot, we can do the stuff we need to do, but if the founder's not up for that, it doesn't go anywhere. And that's where the book came in. So past life, the companies that I built were behavioral assessment businesses in the talent selection space. And my last company was a company called Outmatch. Now it's called Harvard, was one of the global leaders in talent selection and identifying talent fit for some of the biggest brands in the world. So we had a team of industrial psychologists and people like that we worked with, and we sat down with them about a year and a half ago and said, hey, wouldn't it be interesting if we can apply those same principles that we were using when we were trying to help American Airlines select pilots, or we were trying to help Subway restaurants select managers and things like that? And wouldn't it be interesting if we can apply that same kind of thinking, but we do it for founders? So what we actually did is, because we need to get good at this, right? As fund managers, we need to get, and as any investor, you need to get really good at that. So we went out, we got a few dozen founders that we have worked with that have been extraordinarily successful over the years. And we define that as, if you've had multiple 9-figure exits, you've repeated, you've positioned a company, you got to scale, you got it done. And that's what we built. That's what we used as our sample. And we started doing research on them and taking a behavioral analytics approach to it, and started giving them different kinds of assessments and everything to build out our own framework. So that, again, this started so that we could use this as a screening tool for the fund. And that's what we did. Spent about a year and a half doing this research, produced a white paper on it with this, what we call this adaptive innovator archetype model, which I'll explain in a second. And we created this white paper, and there was a lot of interest around it, and said, wouldn't it be fun if we actually try to turn this into a book? And so we did. And we took that and we turned it into a book called The Adaptive Innovator, which may be out by the time that this podcast airs, but right now it's March 5th. It'll be out in the next couple of weeks. And in that book, we wrote actually as a parable, and it was a fun process to go through, where we wrote it as a parable about a fictitious founder named Alex. And Alex works with his executive coach named Meredith, who was brought in as a last-ditch effort by their VC fund to try to save Alex and save the company. And Meredith teaches Alex all about these principles of the adaptive innovator model, and really how to be an effective founder. So it was an amazingly fun project.
That's so
Super
cool.
excited about it. Yeah, yeah. And it just makes it a lot more, it's not your typical business book, right? It's not a research heavy book. It's based on a ton of research, but it's a very easy to understand. It's a quick read. This is a 2-hour airplane ride read, but it's really designed to help founders or investors really just think about what should they be looking for, both in themselves or in the founders that they're investing in.
And what were some of the findings?
We talked about this archetype model that we built, and it's based on 4 pillars that we created that came out of it, right? And this was ground up research that we built. The 4 pillars that we discovered, number 1 is creative resilience. And there's this interesting thing about founders. They almost have to have the suffering and the challenge and the fight. Different than normal people. In a way that it's like the farther they get, I'll use the boxing analogy. Mike Tyson used to talk about he couldn't actually start a fight until somebody punched him in the face. So if you watch Mike Tyson in his early days, right, Mike Tyson would actually almost lean into a punch to start the fight. And it was the craziest thing, right? And it's almost like this thing that founders have where they need that fight. They need to be boxed into the corner so that they can really start, because that's where the innovation comes from. Mm-hmm. And that we call it creative resilience because the resiliency is the creativity. They get better with the fight. They get better with the struggle. It's different than the normal population. And it's one of those things that's really characteristic, really defines world-class founders. They need the fight, they need the struggle, and that's what's going to bring out the creativity, and that's what's going to bring out the innovation. The second pillar is what we call humble assertiveness. This is one that we kept looking at this and looking at it and saying, this does not fit any kind of model that you think about with most founders, right? Like most founders you think about are the stereotypical model of the Elon Musk or the Steve Jobs or the Jeff Bezos. They're the dominant personalities, right? They're this force of life figure. And while there's certain aspects of that, what we found in this, they're multi-generational founders, right? Not everybody, you don't need to be that to succeed at a really high level. What we found is that this concept of humble assertiveness really related to the leadership style, and that what great founders do is they let their team lead. Where they're going to pound the table and where that assertiveness is going to come out is when you've got a major strategic difference on what is our North Star? Where are we going? That's where they're going to pound the table hard. They're going to be the loudest voice in the room. How they get there, though? They're going to let the team drive that. They're going to let the team be the voice. And it's a different thing than I think most people, they're going to take the firm position, but it's going to be really selective where they're going to take it. But it's going to be on the big strategic direction. We talk all the time, like I mentioned Jeff Bezos, right? Bezos has this kind of pretty famous decision-making framework of the 1-door and 2-door decisions. If you've ever heard of this before, the 1-door decision, the 2-door decision is they're easy decisions to make. You walk through the door. If you discover you made the wrong decision, turn around and walk right back out, right? Under the decision. No big deal. 1-door decisions, they're a very small percentage of the decisions, but when you make them, you need to get it right. And because it's really hard or really expensive to try to undo it. So think about core architecture of your software, hiring a key executive, bringing on new capital, things like that, right? It's hard to undo that stuff if you feel like you've made the wrong decision later. That's where humble assertiveness is going to come up. Those 1-door decisions are going to pound the table hard. The 2-door decisions, they're going to let their team run. It makes sense when you think about the contrast of that, which is what we see often. I think any investor that's been an angel investor for a while or any institutional will have this. The contrast to that is the founder who ends up becoming the roadblock. They just end up being in the way of everything. Not like they're in every decision, not that everything slows down. They're just like causes confusion, mass confusion. So that would be the opposite of what we think about with humble assertiveness. Third one is around balanced risk taking. That, what great founders, and this particularly is the case when we find when they were on their second venture, they get really great at how to balance risk. They're not making bet the company decisions over and over again. Where you see a lot of founders that when they don't have that balance, every decision becomes a company killer. Sometimes we get it right, but eventually they don't. And So being able to really understand balance risk taking, right? Really understand, like, how do we take risk? How do we think about risk? How do we run experiments, right? That are controlled experiments. And then we do a lot of those things. So they're constantly in motion, right? But how do we do those controlled experiments? And then the one or two that really work, then we go big, right? And that's what balance risk taking is all about. And that was a big area of difference. And the last one, which personally, I think out of all four of these things, the first three, you can coach this to a certain extent. You can, as long as somebody has the core, you can make them better. The fourth one, I think, and my partner thinks this is the one, this is the true deal killer for us, is strategic accountability. What great founders do is they are the first person to accept blame. They are the first person to accept responsibility. What this goes to is the coachability of the person. If they're defensive, if they're not willing to take coaching, we won't invest. It's just plain and simple. Like we won't do it. I don't care how good their idea is. I don't care what their track record has been. I just don't want to deal with it. This is the one that I think more than anything, investors just feel this viscerally. And I'm sure, I know I've got people in mind right now. I know you do too. You've been invested for a while. Everybody listening to this says, oh, I remember that one. This one's the one. To me, this is the deal killer. You got to be, this is the truth. There's that leadership axiom. That old leadership axiom is like, when things go well, the credit belongs to the team. When things go poorly, the blame belongs on me. And this is where you see that more than anything. So that's the framework that we built, and we turned it into an assessment. We use it for our own founder selection, and we coach around it. And it's been fun.
So during the diligence process, then you can use this assessment to figure out if they really have this number 4, especially.
Oh, completely. Yeah. We ask any potential founder that we're going to invest in to take the assessment. One of the things that's really interesting is we'll have founders say, no, I'm not going to take an assessment, or I don't believe in it. So they're out. This is our model. And I think one of the things with investing that you have to get really good at is figuring out, like, what works for you. What is the model that you need to stick with? And I think when you look at, we have a lot of angel investors that have now invested in our fund and things like that. And, where you see the struggles when angel investors are doing this is they become very lax on the standards, and they're not following their own process a lot, or making exception, or the process isn't really defined. And I think, so this is just part of the core process, but we're not only using it in diligence, we're also using it with our current portfolio to help develop the founders. This is language we're talking about with
That's
that.
awesome.
Again, number 4, the strategic accountability. I can honestly say, of my remaining portfolio, because we have had a couple, again, this is early stage investing, of my remaining portfolio, every one of them fits that, because that's the screen out. But the other ones, we're constantly coaching and developing around this, because it's incredibly important stuff.
That is really interesting. Thanks for sharing with us, because we will definitely want to read the book. The book sounds fun. It's the 5 dysfunctions of a team, like that's notable there, right?
I'm a huge Pat Lencioni fan, so
Yeah.
so I'm not ashamed to admit that we completely lifted the idea of how to write this from Pat.
Hey.
Yeah, I'm a huge fan.
People love stories. We love to hear stories. We want to hear you tell us stories, not give us facts, right? So before I let you go, Greg, tell us a little bit about what we can expect in the Denver ecosystem as we hit the ground in April for the Angel Capital Association Summit.
I'm super biased, obviously. So I'm a native New
course.
Yorker.
Yeah.
I'm a native New Yorker moving to the mountains in Colorado, and we're about 30 minutes outside of Denver, up in Evergreen. But yeah, there's an incredible ecosystem in Denver that's been formed. There's a strong venture community there. You've obviously got Boulder, which has been, one of the premier venture and tech areas in the country. But Denver itself has really grown into a phenomenal tech ecosystem is there. There's some great companies forming there. There's some really great venture funds that are floating around there, and it's growing. It's growing every day. Like I said, I'm completely biased, but I don't think there's a better place in the country to certainly have a conference like that, or come build a tech company. Denver's a big city. We've got transportation to anywhere in the world, pretty much nonstop from Denver Airport, and some remarkably sophisticated and successful talent in the ecosystem to help build. Yeah, I think you're gonna have a great time in Denver.
Yeah, we're excited.
And if you're up in Evergreen and you want to do a hike and you're at the conference, about 30 minutes outside, we'll connect with me on LinkedIn and ping me that you're there, and we'll take you on some good hiking up about 30 minutes outside of town in Evergreen, which is the namesake of our fund. Evergreen Mountain Equity Partners. You can go climb the Evergreen Mountain. Take you up myself.
Nice. Greg, thanks so much for coming and explaining all of this. I know I'm anxious to read the book, and I want to hear the story all about Alex and Meredith.
Yeah, I'm excited to share it with you, and I'm really excited to be out. It's writing a book this is my second book, and I forgot after the first one what kind of a labor of love this is. Yeah, I can't wait
Yes.
to. It's a lot of labor and a lot of love.
That's right. That's exactly right.
Looking forward to having it out.
Great. Thanks, Greg.
Thank you.
Thanks for listening. To connect with me, visit my website at marciadawood.com. And please subscribe, follow, and leave a review. It helps the podcast get seen by more people. And remember, you can also find the Angel Next Door podcast on YouTube too. And if you're looking to learn more about investing in the changes you want to see in the world, sign up for Ann and Bill Payne's ACA Angel University classes. Go to theangelcapitalassociation.org, all one word, to find out the schedule. And classes are now available on demand. Many classes are offered, everything from angel investing basics, which include fundamentals, risk, due diligence, term sheets, valuations, returns and portfolio strategy, and even a class on group formation. There's even a deeper dive where you can get advanced classes, including capitalization tables, startup boards, and exit strategies. If you're not already a member of the Angel Capital Association, you can become one for a low price that will give you unparalleled access to discounts, free webinars with a huge archive of content, networking opportunities, and much more. We'd love to have you join us. All content for this website is informational and not intended to serve as legal, tax, accounting, or investing advice. While Marcia, that's me, does serve on the SEC Small Business Capital Formation Advisory Committee, my views are my own and not the views of the SEC or my fellow colleagues on the committee. Our speakers and hosts are thoughtfully selected for their educational value, but their opinions are their own and do not necessarily represent the views of the host, me, or the Angel Capital Association, and neither specifically endorse the use of presenters' products or services. Listeners of the podcast should consult their own tax, investing, legal, or accounting advisors before making important financial decisions. All warranties, including accuracy, completeness, and suitability for specific purpose, are disclaimed.